Welcome back to Retiring Today. We're playing the game of life with a retirement twist. I'm here with Loren Merkle. He is an avid board gamer, a certified financial fiduciary, and a certified financial planner. But I just want to say right now, I'm still in the lead. We decided we'll spend one more time to finish this out here. Oh, geez.
That's not a good
It
spin.
didn't
You
go all
should
the
have
way
a penalty
around.
just for the
That
spin.
was like if you're on The Price is Right, you don't go all the way around. Okay, I did roll a 5. I will move 5. Ooh, look how close to retirement I'm getting. Wait, I got rid of the kids.
What was that award you got again? The family award?
No, they
Best
left
family?
the nest. Look, let's get them out of there. They're out of the house now finally as I head towards retirement. So I have to pick up a card. I'll put my family back in,
Well,
please.
they'll be okay. They're going swimming.
Oh, mine says run a marathon, which if I can still run a marathon when I head to and through retirement, I ran one once in my 20s, but
I got faith. You can do
yes,
it.
that would be an amazing accomplishment. All right, let's have you roll one more time.
One more?
Yeah, why not?
All right, 8. Let's take the card. Your pet goat wins a ribbon. Tell everyone its name. Buster. His name's
Buster is your pet goat.
And then I collect $120,000 from the bank.
That's a nice payday. That goat really return on investment was
take
good
Buster.
there.
Buster's good.
So we're going through the retirement game of life. We've been working through the different phases of retirement, and that is the game of life. They are cracking up behind the cameras at us. We're having fun today. We hope you're having fun watching too. So the next part of the game of life you might land on is age 72. What happens at 72?
At age 72, this is where this surprise creeps in for a lot of retirees, because now they start to see the pain of being mandated to take distributions from these pre-tax retirement accounts. Most pre-retirees and retirees today, the main option from a retirement savings standpoint that you've always had is to put money on a pre-tax basis into these accounts. And it grows tax deferred until you take it out, or you reach 72, and now the IRS mandates you start taking distributions out of these accounts. So by this time, you've employed, if you've done the planning, you've employed a Social Security maximization strategy. So you're taking your Social Security, you're not turning that off. If you have a pension, you've taken your pension, you're not turning that off. And now you're mandated to take this distribution that is all taxable from your pre-tax accounts. So you have layers of this income, which is good. It's nice to have that income, but how much of that income do you get to keep? Because it's all subject to tax. So what you are right now, is you're subject to tax rate increase risk. And most people think today taxes are going to go up before they go down. And at age 72, you can't control what the tax rates are going to do. You can't control your income anymore. And this is why a lot of planning needs to take place prior to 72. So if you're 58 years old right now, you're not planning to retire for 5 years, and you're thinking, well, I don't need to do this retirement planning stuff yet. The answer to that is wrong, because there's a lot of tax planning that you can incorporate, because now you have 14 years that you can engage in effective tax planning with tax rates on sale today. So at your age 72, you're not hit with this ticking tax time bomb of required minimum distributions.
Yeah, you'd sort of like to sometimes take your game of life piece and move it back on the board, but as we all know, that doesn't happen. Let's go back to the RMDs a little bit, because you've helped people retire hundreds of times. 72 doesn't surprise you, because you know. But I'm only going to turn 72 once. You're all only going to turn 72 once. So sometimes RMDs are still sort of a surprise to people, aren't they?
They can be a surprise, and it's not necessarily uncommon that we run into somebody who had forgotten to take their RMD at 72, and it used to be 70.5. So whether it was 70.5 or 70, they forgot to take it, and then there's a 50% penalty that's applied to the amount you should have taken that you didn't take. Plus, you still have to pay taxes on it as well. So it's a steep penalty. We don't want to forget it. We want to know it's on the radar. And then again, if you're not 72, not 70.5, you're not forced into it yet, you're going to be. Let's do something about it before you have that mandate upon you.
Thank you for watching this clip of Retiring Today, and don't forget to subscribe. If you have questions about your retirement plan, take advantage of the complimentary 15-minute retirement checkup phone call.